President Biden speaking from the White House earlier this afternoon, outlining his latest plan to lower gas prices. Let's take a listen.
Today, I'm announcing 3 critical steps that my administration will take to reduce gas prices at the pump. First, the Department of Energy will release another 15 million barrels from the Strategic Petroleum Reserve, extending our previously announced release through the month of December. With my announcement today, we're going to continue to stabilize markets and decrease the prices. I've told my team behind me here to be prepared to look for further releases in the months ahead if needed. We're calling it a ready and release plan.
All right, let's talk about what this means for the energy markets. For that, I want to bring in Alan Knuckman, BullseyeOption.com's chief market strategist. Alan, it's great to see you. So we just got this announcement from President Biden, and then we also got the data just regarding supplies. It seems like that's really the driver in today's action with oil back above 85 a barrel. I guess your reaction first to what we just heard from the president and the potential implications there.
Well, the president in reality cannot control the price of energy, control the price of oil or gas prices. They try and tamper it because it's a big issue for the markets and for people in general, especially consumers. But if you look at it, we've been trading roughly between 85 and 95 in crude oil for the last 3 or 4 months. We did have a failed test to the downside, and we bounced back up again. So I'm still optimistic overall that in price could move back up once again. But let's put it in perspective. We're still half of the price from 2008, if you adjust for inflation, would have to be above $200 a barrel.
It's interesting. I'd love to hear what he means by if needed, because theoretically it's only needed politically speaking. This is not to solve an emergency as the SPR usually is. He also follows that with a tweet, and it says, when the cost of oil comes down, we should see the price at the pump come down as well. That's how it should work. But right now, refiners and retailers are making record profits at the expense of Americans. What does he have right? What does he have wrong?
Well, it's capitalism. Again, the president does not control the price. That'd be a whole different country if the president could determine the price of energy, and he can't. But that's one of the strongest sectors of the market. If you look at any of the oil companies over the last year and over the last couple of weeks, we've seen a big rebound in oil and oil services companies. We've got Schlumberger, Halliburton, Oxy. You know, everybody's had a big bounce, and it looks like we're going to make another attack on those highs. So we've been seeing that sector lead the way here, and we've seen a bounce in the overall market. Let's remember that there's still a lot more upside in these oil company stocks. They have the lowest PE of around 9 or 10 compared to any sector in the S&P. So there's still more upside and money to be made in these particular stocks and sector, even though it looks like the price of gas may be going higher in the near term.
Alan, how much higher could the price of gas go, do you think?
Well, it could go back up. But again, we had a pretty sharp decline. Let's talk about what's happening, and your last guest alluded to it. It's all about the dollar. The dollar had a key reversal a couple weeks ago where it made new highs and that had a lower weekly close. That is destructive for the dollar. So if the dollar can decline, that's going to be very much a positive for stocks and for oil. So that's something to watch. And the key component, obviously, is interest rates. Interest rates are going to top out at 5% here in 2023, and then they decline after that. 2024, 2025, they all stabilize around 4% all the way out to 2030. So that's the market telling us that the rate hike cycle is going to be done, and the dollar shouldn't go up anymore. That's going to push the energy and commodity complex higher, and that's going to hurt the consumer. But like I said, there's money to be made in some of these stocks that will benefit from it.
Got to push you a little bit. Dan Dicker here yesterday on the program said $120 a barrel early 23. Do you agree with that? Do you at least see over $100 a barrel?
Yeah, I see $100 a barrel. That's, again, like I said, that would be half of where we were. I know it hurts psychologically, and it's a red button issue for people, but that's still half off of 2008. The Fed got what they wanted. They knocked oil prices down. They knocked them down 35%. But I see that as a temporary respite here. And crude oil always has price pop potential. And you understand there are a lot of people around the world that have a vested interest in higher energy prices, and they're going to do what they're going to do because that's how they make money.
Let's talk about the energy crisis in Europe. Obviously, a huge story, a huge mover here throughout the energy sector. EU companies, at least right now, at odds just over how best to tackle the energy crisis. What's your takeaway? And I guess, what do you think should be done at this point?
I just got back from Europe, and they live a different lifestyle than we do. Their inflation rate has been much higher, and I took advantage of the strong dollar. Being American for that trip. It's always in flux, and they live, like I said, a different lifestyle than we do. Everybody was driving the little cars, and it got a good chuckle out of me to not see a truck. I did not see a pickup truck probably for 3 or 4 days, which is, like I said, a different lifestyle. And they're just used to these things. And it's a cycle that we all have to get through. And prices move up, prices move down. That's what we do as traders, is we take advantage of those price movements. But I think there's more pop when it comes to these energy prices, especially here in the wintertime.
You get a Gucci bag, a Prada bag. Curious to hear how you made that.
Shoes. I got some shoes.
Okay. I'm curious back here, the Strategic Petroleum Reserve, we're talking 1984 type levels. What are the implications?
Again, it's nothing but psychology. It's psychology and sentiment. And right now, it's an interesting time for me as a trader. I have never seen the sentiment this negative. Now, let's remember where we were in 2008. And things were much, much different. We actually had a real financial crisis. Now we've got too many jobs and too few people. And you've got corporate profits and margins at record levels. So, it's a disconnect. I think the average consumer, the average American, is very concerned about the economy, but we're 70% off the COVID lows in the S&P and 20% off the highs. We made 70 some new all-time highs just last year alone. So yeah, the market's taken a little bit of a break. But if you do it on a PE ratio, right now we're at 15. Think about what percentage that is off the high back in January. We're 30% off the high in the PE. So stocks are cheap. At some point, people are going to realize that. I just don't know when.